Imagine waking up one morning to find your money has magically grown overnight, without you lifting a finger. Sounds too good to be true, right? But what if I told you this is exactly what happens when you invest your money wisely? I'm talking about the power of compound interest, and it's something that can change your financial life forever. If you're new to investing and have between $1,000 to $10,000 to get started, this video is for you. We're going to cover the basics of investing, including index funds, ETFs, and a strategy called dollar cost averaging that will help you sleep better at night. So, let's start with the basics. What is investing, anyway? Simply put, investing is putting your money into something that has a good chance of growing in value over time. This could be stocks, bonds, real estate, or even a small business. The key is to find something that has a strong track record of success and to hold on to it for the long haul. Now, I know some of you might be thinking, but I don't know the first thing about investing. Don't worry, you're not alone. Investing can seem intimidating at first, but trust me, it's easier than you think. One of the simplest and most effective ways to get started is with index funds. An index fund is a type of investment that tracks a specific stock market index, like the S&P 500. This means that when you invest in an index fund, you're essentially buying a small piece of the entire stock market. The beauty of index funds is that they're incredibly diversified, which means your risk is spread out across hundreds of different stocks. This makes them a much safer bet than trying to pick individual stocks on your own. For example, let's say you invest $5,000 in an index fund that tracks the S&P 500. Over the course of a year, the S&P 500 goes up by 10%. At the end of the year, your $5,000 investment would be worth $5,500. That's a gain of $500, just for doing nothing. Now, you might be wondering how index funds make money. It's actually pretty simple. When you invest in an index fund, you're paying a small fee to the company that manages the fund. This fee is usually a percentage of your investment, and it's used to cover the costs of running the fund. For example, if you invest $5,000 in an index fund with a 0.05% fee, you'll pay $2.50 per year in fees. That's a small price to pay for the convenience and diversification that index funds offer. Another popular option for beginners is ETFs, or exchange-traded funds. ETFs are similar to index funds, but they trade on an exchange like individual stocks. This means you can buy and sell ETFs throughout the day, whereas index funds are typically traded at the end of the day. ETFs are also often more tax efficient than index funds, which can be a big advantage if you're investing in a taxable brokerage account. For example, let's say you invest $2,000 in an ETF that tracks the Dow Jones Industrial Average. Over the course of a year, the Dow goes up by 12%. At the end of the year, your $2,000 investment would be worth $2,240. That's a gain of $240, just for doing nothing. Now, let's talk about compound interest. Compound interest is like a superpower for your money. It's the idea that your investments can earn interest on top of interest, which can lead to some pretty astonishing growth over time. For example, let's say you invest $5,000 in an index fund that earns an average annual return of 7%. Over the course of 10 years, your investment would grow to over $10,000, even if you don't add a single penny to it. That's the power of compound interest. But here's the thing, compound interest only works if you're patient and consistent. You can't just invest your money and then forget about it. You need to make regular contributions to your investments, and you need to be willing to ride out the ups and downs of the market. That's where dollar cost averaging comes in. Dollar cost averaging is a strategy where you invest a fixed amount of money at regular intervals, no matter what the market is doing. This helps you smooth out the ups and downs of the market and avoid trying to time your investments perfectly. For example, let's say you invest $500 per month in an index fund every month for a year. Some months the market will be up, and some months it will be down. But over the course of the year, your average cost per share will be lower than if you had invested a lump sum at the beginning of the year. This is because you're buying more shares when the market is down, and fewer shares when the market is up. It's a simple but powerful strategy that can help you build wealth over time. Now, I know some of you might be thinking, but what about the fees? I don't want to pay a lot of money in fees. And that's a fair concern. Fees can eat into your investment returns over time, so it's important to keep them as low as possible. One way to do this is to look for index funds or ETFs with low expense ratios. An expense ratio is just a fancy term for the fee that the fund company charges. For example, if you invest in an index fund with an expense ratio of 0.05%, you'll pay $2.50 per year in fees for every $5,000 you invest. That's a small price to pay for the convenience and diversification that index funds offer. Another way to keep fees low is to invest in a tax-efficient manner. This means investing in tax-deferred accounts like 401(k)s or IRAs, and avoiding investments that generate a lot of taxable income. For example, let's say you invest $5,000 in a taxable brokerage account, and it earns an average annual return of 7%. Over the course of a year, you'll owe taxes on the gains, which can eat into your returns. But if you invest in a tax-deferred account, you won't owe taxes until you withdraw the money in retirement. This can be a big advantage if you're investing for the long haul. Now, I know some of you might be thinking, but what about the risks? I don't want to lose all my money. And that's a fair concern. Investing always involves some level of risk, but there are ways to manage that risk. One way is to diversify your portfolio by investing in a mix of different asset classes, like stocks, bonds, and real estate. This can help you smooth out the ups and downs of the market and reduce your overall risk. Another way to manage risk is to invest for the long haul. The longer you hold on to your investments, the less volatile they tend to be. For example, let's say you invest $5,000 in an index fund that tracks the S&P 500. Over the course of a year, the S&P 500 might be up or down by 10% or more. But over the course of 10 years, the S&P 500 has historically returned around 7% per year, on average. That's a much more stable return, and it's one reason why investing for the long haul can be so powerful. So, what's the takeaway from all this? If you're new to investing and have between $1,000 to $10,000 to get started, the key is to keep it simple and be consistent. Invest in a mix of index funds or ETFs, and make regular contributions to your investments. Use dollar cost averaging to smooth out the ups and downs of the market, and keep your fees as low as possible. And most importantly, be patient and give your investments time to grow. With compound interest on your side, you can build wealth over time and achieve your long-term financial goals. And if you're still unsure where to start, don't worry. There are plenty of resources available to help you get started. You can start by researching different index funds or ETFs, and reading up on investing strategies like dollar cost averaging. You can also talk to a financial advisor or use an online brokerage account to make investing easy and convenient. So, what are you waiting for? Start investing today and take the first step towards building wealth over time. And if you found this video helpful, be sure to like and subscribe for more content on personal finance and investing. And if you have any questions or topics you'd like to discuss, leave them in the comments below. Thanks for watching, and we'll see you in the next video.